Question 1. When evaluating a potential real estate investment for a client in Connecticut, which of the following best represents a broker's responsibility regarding risk assessment and management? Option A. Advise the client to conduct their own independent risk analysis and research without providing specific disclosures about the investment's inherent risks. Option B. Focus primarily on the potential for high returns, as the client has expressed a desire for aggressive investment growth. Option C. Conduct a thorough risk assessment, clearly explaining all potential downsides and ensuring the client understands their financial capacity to absorb losses, in addition to discussing potential returns. Option D. Assume the client's risk tolerance is high based on their stated interest in aggressive investments and proceed with marketing the opportunity. Correct answer is C. Conduct a thorough risk assessment, clearly explaining all potential downsides and ensuring the client understands their financial capacity to absorb losses, in addition to discussing potential returns. Explanation. This scenario is professionally challenging because it requires a real estate broker in Connecticut to balance a client's desire for aggressive returns with the fiduciary duty to ensure the client understands and can tolerate the associated risks. The broker must act in the client's best interest, which includes providing clear, unbiased information about potential downsides, not just the upsides. Connecticut general statutes, particularly those governing real estate brokers and their duties to clients, emphasize honesty, integrity, and the avoidance of misrepresentation or concealment of material facts. The broker's role is to facilitate an informed decision, not to guarantee outcomes or push a particular investment. The best approach involves a comprehensive risk assessment that goes beyond simply presenting potential profits. This includes thoroughly discussing the specific risks inherent in the proposed real estate investment, such as market volatility, liquidity issues, potential for capital loss, and the client's financial capacity to absorb such losses. The broker must ensure the client understands these risks in the context of their personal financial situation and investment objectives. This aligns with the ethical obligation to act with reasonable care and diligence, and to provide advice that is suitable for the client. Connecticut law requires brokers to disclose all material facts that could affect a client's decision, and this includes a candid assessment of risks. An approach that focuses solely on the potential for high returns without adequately detailing the downside risks is ethically flawed and potentially violates Connecticut's real estate licensing laws. Such an approach misrepresents the investment opportunity by presenting an incomplete picture, leading the client to make a decision based on incomplete or misleading information. This failure to disclose material risks can be construed as a breach of fiduciary duty and a violation of the duty of good faith and fair dealing. Another incorrect approach is to assume the client's risk tolerance based on their stated desire for high returns. Risk tolerance is a complex personal attribute that requires careful exploration and confirmation, not mere assumption. A broker must actively probe and document the client's understanding of risk and their capacity to withstand potential losses. Relying on a client's initial enthusiasm without a thorough assessment can lead to unsuitable investment recommendations and potential harm to the client. Finally, an approach that defers all risk assessments solely to the client without providing expert guidance and disclosure is also problematic. While the client ultimately makes the decision, the broker has a professional responsibility to educate and inform them about the risks involved in real estate investing. Simply telling the client to do their own research without providing a foundational understanding of the specific risks of the proposed investment fails to meet the standard of care expected of a licensed professional. The professional decision-making process should involve a structured approach. First, understanding the client's overall financial goals and risk tolerance through open-ended questions and active listening. Second, conducting thorough due diligence on the proposed investment to identify all potential risks and rewards. Third, clearly and comprehensively communicating these risks and rewards to the client in a manner they can understand, using plain language and avoiding jargon. Fourth, documenting the entire risk assessment process and the client's understanding and acceptance of the risks. Question 2. The analysis reveals that a prospective homebuyer in Connecticut is seeking guidance on financing options for their purchase. As a licensed real estate broker, what is the most appropriate course of action to ensure the client makes an informed decision while adhering to Connecticut's real estate regulations? Option A. Offer detailed financial projections and advise the client on which specific loan product is financially superior for their situation, based on the broker's understanding of the market. Option B. Present a list of available mortgage products from different lenders without elaborating on their specific features or potential implications for the buyer. Option C. Provide a detailed explanation of various mortgage types, including fixed rate, adjustable rate, conventional, FHA, and VA loans, highlighting their general characteristics and potential impacts, while advising the client to consult with a mortgage lender for personalized advice. Option D. Recommend a specific mortgage lender that the broker has a good working relationship with, suggesting they can offer the best rates and terms for the client. Correct answer is C. Provide a detailed explanation of various mortgage types, including fixed rate, adjustable rate, conventional, FHA, and VA loans, highlighting their general characteristics and potential impacts, while advising the client to consult with a mortgage lender for personalized advice. Explanation. The analysis reveals a scenario where a Connecticut real estate broker must advise a client on financing options for a property purchase. The situation is professionally challenging because the broker's role extends beyond merely facilitating a transaction. It involves guiding the client through complex financial decisions that have significant long-term consequences. The broker must possess a thorough understanding of various financing mechanisms and their implications, ensuring the advice provided is in the client's best interest and complies with Connecticut real estate licensing laws and ethical standards. The best approach involves the broker thoroughly explaining the fundamental differences between various mortgage types, such as fixed-rate versus adjustable-rate mortgages, conventional loans, FHA loans, and VA loans, focusing on their respective interest rate structures, repayment terms, and eligibility requirements. This explanation should empower the client to make an informed decision by highlighting how each option might impact their monthly payments, overall cost of borrowing, and long-term financial stability. The broker must also emphasize that they are not financial advisors and that the client should consult with a qualified mortgage lender or financial professional for personalized advice and pre-approval. This approach aligns with Connecticut General Statutes, Chapter 412, which governs real estate brokers and salespersons, and emphasizes the duty of honesty, integrity, and fair dealing. It also adheres to ethical principles that require brokers to act in the best interest of their clients and avoid misrepresenting financial products. An incorrect approach would be for the broker to recommend a specific lender or loan product based on personal relationships or potential referral fees without a comprehensive explanation of the client's options. This failure to provide a balanced overview of available financing types and their implications violates the duty of loyalty and fair dealing owed to the client. It could also lead to the client choosing a loan that is not the most suitable for their financial situation, potentially resulting in future difficulties. Furthermore, accepting referral fees without proper disclosure could violate Connecticut's disclosure requirements for real estate professionals. Another incorrect approach would be for the broker to provide detailed financial projections and advice on which loan type is best, without being a licensed financial advisor. This oversteps the broker's scope of practice and could lead to the client making decisions based on inaccurate or incomplete financial guidance. Connecticut law requires real estate licensees to operate within their designated professional boundaries, and offering unlicensed financial advice is a violation. Finally, an incorrect approach would be for the broker to simply present a list of loan options without explaining the core differences and potential impacts of each. This passive approach fails to adequately inform the client, leaving them to navigate complex financial decisions without sufficient understanding. It demonstrates a lack of diligence and a failure to uphold the fiduciary duty to act with reasonable care and skill on behalf of the client. Professionals should adopt a decision-making framework that prioritizes client education and informed consent. This involves understanding the client's financial goals and risk tolerance, clearly explaining all relevant options within the scope of their expertise, and strongly recommending consultation with qualified financial professionals for personalized advice. Transparency, honesty, and a commitment to the client's best interest should guide every interaction. Question 3. The evaluation methodology shows that a registered representative holding a Connecticut broker license is preparing for their license renewal. They recall attending various financial industry seminars over the past 2 years, some of which were general industry updates and others focused on specific investment products. They are unsure if these seminars meet the specific continuing education requirements mandated by the Connecticut Department of Banking for license renewal. Which of the following actions best demonstrates adherence to Connecticut's regulatory framework for continuing education? Option A. Proactively consulting the Connecticut Department of Banking's official website to verify the specific continuing education credit requirements, approved course categories, and reporting procedures for license renewal. Option B. Assuming that the general financial industry seminars attended are sufficient, as they provided valuable updates on market trends relevant to their practice in Connecticut. Option C. Completing only the minimum number of continuing education hours that they believe are required, without verifying the specific content or approval of the courses with the Connecticut Department of Banking. Option D. Relying on the advice of a colleague who believes that any seminar related to financial services generally counts towards continuing education in Connecticut. The correct answer is A. Proactively consulting the Connecticut Department of Banking's official website to verify the specific continuing education credit requirements, approved course categories, and reporting procedures for license renewal. Explanation. The evaluation methodology shows that navigating the nuances of licensing requirements and continuing education mandates in Connecticut presents a professionally challenging scenario. A financial professional must exercise careful judgment to ensure compliance with the Connecticut Department of Banking regulations, which are designed to protect consumers and maintain the integrity of the financial services industry. The core challenge lies in accurately interpreting and applying these rules to one's specific professional circumstances, especially when faced with evolving regulatory landscapes or personal changes that might impact licensing status. The best professional practice involves proactively understanding and adhering to the Connecticut Department of Banking's specific requirements for initial licensure and ongoing continuing education. This includes identifying the precise number of credit hours required, the types of approved courses, and the deadlines for completion. It also necessitates maintaining accurate records of completed education and promptly reporting any changes in employment or business address that could affect licensing. This approach is correct because it directly aligns with the regulatory framework established by the Connecticut Department of Banking, which mandates these requirements to ensure licensees possess current knowledge and ethical standards. Adherence to these rules prevents disciplinary actions, license suspension, or revocation, thereby safeguarding the professional's ability to practice and maintaining consumer trust. An incorrect approach would be to assume that continuing education requirements are uniform across all states, or that a general understanding of financial industry best practices suffices. This fails to acknowledge that Connecticut has its own specific statutes and regulations governing broker-dealer licensing and continuing education. Relying on assumptions rather than consulting the official Connecticut Department of Banking resources constitutes a significant regulatory failure, as it can lead to non-compliance and potential penalties. Another incorrect approach is to delay or neglect the completion of continuing education until the last minute, or to only complete the minimum required hours without considering the quality or relevance of the courses. This demonstrates a lack of commitment to professional development and a disregard for the spirit of the regulations, which aim to ensure licensees are well informed about current market trends, legal updates, and ethical considerations pertinent to their practice in Connecticut. Such an approach risks overlooking critical information and could lead to inadvertent violations. Finally, an incorrect approach involves failing to report changes in employment or business location to the Connecticut Department of Banking in a timely manner. Licensing is tied to specific affiliations and operational details. Omitting this reporting duty can lead to a lapse in licensure or operating under an invalid license, which is a serious regulatory offense. The professional reasoning framework for such situations should involve a commitment to continuous learning and proactive compliance. Professionals should regularly consult the Connecticut Department of Banking's official website and publications for the most up-to-date licensing and continuing education requirements. They should also establish internal systems for tracking deadlines and maintaining accurate records. When in doubt, seeking clarification directly from the Connecticut Department of Banking or a qualified legal counsel specializing in financial regulation is the most prudent course of action. This diligent and informed approach ensures both regulatory adherence and the maintenance of professional integrity. Question 4. Implementation of economic forecasting by a licensed real estate broker in Connecticut requires careful consideration of regulatory compliance and client best interests. A broker is advising a client on purchasing a property in Fairfield County, Connecticut, and is asked for their opinion on how current national economic trends, such as inflation and interest rate hikes, might affect the property's future value. Which of the following approaches best adheres to Connecticut's real estate licensing laws and ethical standards? Option A. Recommend a third-party online prediction tool and present its projected appreciation rate for the property as a definitive forecast, without further analysis or client discussion. Option B. Provide a specific percentage estimate of how much the property's value is likely to appreciate over the next 5 years, directly linking it to current national economic indicators. Option C. Advise the client that national economic factors have no bearing on local real estate values in Connecticut, and that they should focus solely on the property's physical attributes. Option D. Educate the client on general economic principles and how they could influence the Connecticut real estate market, emphasizing that specific future property values cannot be guaranteed and that all real estate investments carry risk. The correct answer is D. Educate the client on general economic principles and how they could influence the Connecticut real estate market, emphasizing that specific future property values cannot be guaranteed and that all real estate investments carry risk. Explanation. This scenario is professionally challenging because it requires a real estate licensee in Connecticut to navigate the intersection of economic forecasting and their fiduciary duties to clients, all while adhering to Connecticut's specific real estate regulations. The licensee must balance providing valuable market insights with avoiding misrepresentations or guarantees that could mislead clients or violate licensing laws. Careful judgment is required to distinguish between informed opinion and unsubstantiated prediction. The best professional practice involves educating clients about general market trends and potential economic influences without making specific predictions about future property values or market performance. This approach involves presenting objective data, discussing broad economic factors that could impact the Connecticut market, such as interest rate trends, employment figures, or regional development projects, and emphasizing that real estate investments carry inherent risks. This aligns with Connecticut general statutes, which require licensees to act with honesty, integrity, and to avoid misrepresentation. By focusing on education and objective information, the licensee fulfills their duty to inform without making promises they cannot keep, thereby protecting both the client and their own license. An approach that involves making specific predictions about the appreciation rate of a particular property or the overall market in a specific Connecticut town is professionally unacceptable. This constitutes a misrepresentation and a guarantee of future performance, which is not only unethical, but also a violation of Connecticut real estate licensing laws. Such predictions can lead clients to make investment decisions based on false pretenses, resulting in financial harm and potential legal recourse against the licensee. Another professionally unacceptable approach is to dismiss all economic factors as irrelevant to real estate transactions. While licensees are not economists, understanding broad economic principles and how they influence local markets is part of providing competent service. Ignoring these factors can lead to clients being ill-informed about potential risks and opportunities, failing to meet the standard of care expected of a licensed professional in Connecticut. Finally, an approach that involves solely relying on online real estate prediction tools without independent analysis or client-specific context is also problematic. While these tools can offer data points, they often lack the nuance of local market conditions and individual property characteristics. Presenting such predictions as definitive without critical evaluation or discussion with the client can be misleading and does not demonstrate the licensee's professional judgment or understanding of the Connecticut real estate landscape. Professionals should employ a decision-making framework that prioritizes client education, objective data presentation, and a clear articulation of market dynamics and associated risks. This involves understanding the Connecticut real estate market's general economic drivers, communicating these in an accessible manner, and always framing information as potential influences rather than guaranteed outcomes. Question 5. To address the challenge of assisting a first-time homebuyer in Connecticut who who is seeking a specific, less common mortgage product. What is the most appropriate course of action for a licensed real estate broker? Option A. Advise the buyer that their preferred niche mortgage product is unlikely to be available and steer them towards more conventional loan options without further investigation. Option B. Guarantee that the buyer will be approved for their preferred niche mortgage product if they work exclusively with a specific mortgage broker recommended by the agent. Option C. Research and present a variety of mortgage products from different lenders that align with the buyer's financial profile, explaining the general requirements and typical approval processes for each. Option D. Recommend a single lender that the broker has a positive past experience with, assuring the buyer this lender can likely accommodate their preferred loan product. The correct answer is C. Research and present a variety of mortgage products from different lenders that align with the buyer's financial profile, explaining the general requirements and typical approval processes for each. Explanation. Scenario analysis. This scenario presents a professional challenge for a Connecticut real estate broker because it involves navigating the complexities of mortgage financing while ensuring full disclosure and avoiding misrepresentation to a client. The broker must balance the client's desire for a specific loan product with the realities of lender availability and the broker's ethical and legal obligations under Connecticut real estate law. Misleading a client about loan options or the likelihood of securing a particular loan can lead to significant financial harm for the buyer and severe legal and professional repercussions for the broker. Correct approach analysis. The best professional practice involves thoroughly researching and presenting a range of available mortgage products from various lenders that align with the buyer's stated financial profile and goals. This approach prioritizes transparency and informed decision-making. Under Connecticut general statutes, specifically those governing real estate brokers and their fiduciary duties, a broker must act in the best interest of their client. This includes providing accurate information about financing options and not making guarantees about loan approvals that are outside of their direct control. By presenting multiple options and advising the client on the general requirements and typical approval processes for each, the broker fulfills their duty of care and avoids making unsubstantiated claims. Incorrect approaches analysis. Recommending a specific lender without exploring other options or providing a comparative analysis fails to meet the broker's obligation to act in the client's best interest and could be construed as steering or having an undisclosed referral arrangement. This approach limits the client's choices and may not secure the most favorable loan terms. Guaranteeing that a specific, niche loan product will be approved, even if it seems like a good fit for the client, is a serious ethical and regulatory violation. Brokers are not loan officers and cannot guarantee loan approvals. Such a guarantee is a misrepresentation of their capabilities and could lead to the client relying on an unattainable outcome, causing financial distress. Focusing solely on the buyer's preferred lender without verifying their ability to offer the desired loan product or exploring alternatives is negligent. It prioritizes the client's stated preference over due diligence and the broker's responsibility to ensure the client has access to suitable and obtainable financing. This can result in delays, failed transactions, and damage to the client's financial standing. Professional reasoning. Professionals in Connecticut should adopt a decision-making framework that emphasizes client centricity, transparency, and adherence to regulatory requirements. This involves 1. Understanding the client's needs and financial situation comprehensively. 2. Conducting thorough due diligence on available financing options from multiple sources. 3. Providing clear, accurate, and unbiased information about these options, including potential benefits and drawbacks. 4. Avoiding any statements or actions that could be interpreted as guarantees or misrepresentations regarding loan approvals or terms. 5. Documenting all communications and advice provided to the client. Question 6. Examination of the data shows a loan underwriter in Connecticut is reviewing an application for a residential mortgage. The borrower has provided documentation indicating a strong income stream, but there are some minor discrepancies in their credit report, and the loan officer has expressed urgency to close the deal quickly due to a sales bonus incentive. Which of the following approaches best aligns with professional best practices and Connecticut's regulatory framework for loan underwriting and approval? Option A. Expedite the approval process by overlooking minor inconsistencies in the credit report and focusing primarily on the borrower's stated income, assuming the loan officer has already performed adequate due diligence. Option B. Approve the loan based on the strong income figures provided, without independently verifying employment or the source of funds, and address any credit report issues after closing. Option C. Conduct a comprehensive review of all submitted financial documentation, independently verify employment and income sources, thoroughly investigate any discrepancies in the credit report, and ensure the loan terms are consistent with the borrower's demonstrated ability to repay, irrespective of internal pressures. Option D. Approve the loan based on the borrower's stated income and the loan officer's assurance, prioritizing a quick closing to secure the sales bonus and meet internal targets. The correct answer is C. Conduct a comprehensive review of all submitted financial documentation, independently verify employment and income sources, thoroughly investigate any discrepancies in the credit report, and ensure the loan terms are consistent with the borrower's demonstrated ability to repay, irrespective of internal pressures. Explanation. This scenario presents a professional challenge because it requires a loan underwriter to balance the lender's need for profitability with the borrower's ability to repay, all while adhering to Connecticut's specific lending regulations and ethical standards. The underwriter must exercise sound judgment to avoid both approving loans that are likely to default and unfairly denying credit to qualified applicants. The best professional practice involves a thorough and objective assessment of all submitted documentation, focusing on the borrower's verifiable financial capacity and the collateral's market value, in strict accordance with Connecticut general statutes governing mortgage lending. This approach ensures compliance with fair lending practices and prudent risk management. It prioritizes the borrower's demonstrated ability to repay and the lender's security, minimizing the risk of default and adhering to regulatory requirements designed to protect both parties. An approach that prioritizes the borrower's stated income without independent verification of employment or the source of funds is professionally unacceptable. This failure to conduct due diligence violates fundamental underwriting principles and potentially contravenes Connecticut's regulations regarding accurate representation of loan terms and borrower qualifications. It exposes the lender to increased risk and could be construed as facilitating predatory lending if the borrower is unable to sustain the payments. Another professionally unacceptable approach is to approve the loan based solely on a desire to meet internal sales targets or to appease a loan officer. This prioritizes business expediency over regulatory compliance and sound financial judgment. Connecticut law mandates that loan approvals be based on objective risk assessment, not on internal pressures or relationships. Such a decision could lead to a high rate of defaults, reputational damage, and regulatory penalties. Finally, an approach that dismisses discrepancies in the borrower's credit report without further investigation is also professionally unsound. Credit reports are a critical component of underwriting, providing insight into a borrower's past financial behavior. Ignoring significant issues or inconsistencies without seeking clarification or additional documentation demonstrates a lack of due diligence and a failure to adhere to prudent lending standards, potentially violating Connecticut's consumer protection laws. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the relevant Connecticut lending statutes and regulations. This framework involves systematically gathering and verifying all required documentation, objectively assessing the borrower's financial profile against established underwriting guidelines, and documenting the rationale for every decision. Ethical considerations, such as fair lending and transparency, must be integrated throughout the process. Question 7. Research into the Connecticut real estate market indicates that a seller wants to list their single-family home for sale. The seller has heard from a neighbor that a specific valuation method, when applied with certain adjustments, can significantly inflate the perceived value of their property, and they are pressuring their listing agent to use this method exclusively to justify a higher asking price. The agent knows this method is not typically the most accurate for this type of residential property and might not reflect true market conditions. Which valuation approach should the agent prioritize to provide an objective and ethically sound estimate of the property's market value in Connecticut? Option A, cost approach. Option B, comparative market analysis, CMA. Option C, a hybrid approach combining elements of all three without regard to typical application for residential properties. Option D, income approach. The correct answer is B. Comparative Market Analysis, CMA. Explanation. This scenario presents a professional challenge because a real estate licensee is being pressured to manipulate a valuation method to achieve a specific outcome desired by a client, rather than adhering to objective valuation principles. This creates a conflict between client satisfaction and the licensee's ethical and legal obligations to provide accurate and unbiased information. The licensee must navigate this pressure while upholding professional standards and Connecticut real estate regulations. The most appropriate approach involves utilizing the comparative market analysis, CMA, as the primary tool for estimating market value. A CMA is a method used by real estate licensees to determine the market value of a property by comparing it to similar properties that have recently sold in the same geographic area. This method is grounded in the principle of substitution, which suggests that a buyer will not pay more for a property than they would for a comparable property. Connecticut real estate licensees are expected to perform CMAs with diligence and accuracy, using objective data and avoiding subjective adjustments that are not supported by market evidence. This aligns with the Connecticut Real Estate Commission's emphasis on providing clients with accurate and reliable information to facilitate informed decision-making. Using the income approach would be inappropriate in this scenario because the property is a single-family residence, not an investment property where rental income is the primary driver of value. While theoretically possible to derive an income stream, it would be an artificial and misleading application of the method for a non-income producing residential property, failing to reflect how such properties are typically valued by buyers and sellers in Connecticut. Employing the cost approach as the sole or primary method would also be problematic. The cost approach estimates value by determining the cost to replace the property with a similar one, minus depreciation. While useful for unique properties or new construction, it often overestimates the value of older properties where depreciation is difficult to accurately quantify and market demand may not support the replacement cost. For a standard single-family home in Connecticut, this method is less reflective of actual market conditions compared to a CMA. Furthermore, presenting a cost-based valuation without strong market comparables could be seen as misleading if it doesn't align with what buyers are willing to pay. The professional decision-making process requires the licensee to first understand the client's objective, but firmly explain the limitations of manipulating valuation methods. The licensee should then proceed with the most relevant and objective valuation method, which in this case is the CMA, and clearly communicate the findings and the methodology used. If the client remains dissatisfied, the licensee should explain that their professional duty is to provide an accurate market assessment, not to engineer a specific price. Question 8. Which approach would be most appropriate for a Connecticut real estate broker representing a seller when there are indications of potential past industrial use on an adjacent property that might impact the subject property's environmental condition? Option A. Advise the seller to avoid any environmental testing to save on transaction costs, assuming the adjacent property's use is not a direct issue. Option B. Downplay the potential environmental concerns to the buyer to avoid delaying or jeopardizing the sale. Option C. Advise the seller to obtain a Phase I environmental site assessment (ESSA) and ensure the buyer receives a copy of the report, along with any other relevant environmental disclosures, to facilitate informed decision-making. Option D. Offer a personal opinion to the buyer about the likelihood of environmental contamination based on the broker's general knowledge of the area. The correct answer is C. Advise the seller to obtain a Phase I environmental site assessment (ESSA) and ensure the buyer receives a copy of the report, along with any other relevant environmental disclosures, to facilitate informed decision-making. Explanation. This scenario presents a professional challenge because a real estate agent must balance their fiduciary duty to their client with the legal and ethical obligations related to environmental disclosures and potential liabilities. The agent must ensure transparency and compliance with Connecticut's environmental regulations without jeopardizing the transaction or misrepresenting the property's condition. Careful judgment is required to navigate potential environmental concerns that could impact property value and buyer decisions. The best approach involves proactively identifying potential environmental concerns and facilitating informed decision-making by all parties. This means advising the seller to obtain a Phase I environmental site assessment (ESA) if there are any indications of past or present environmental issues, such as proximity to industrial sites, underground storage tanks, or historical land use patterns. This assessment, conducted by qualified professionals, can identify potential contamination and recommend further investigation or remediation. The agent should then ensure that the results of the ESA, along with any other relevant environmental reports or disclosures, are provided to the buyer in a timely manner, allowing them to make an informed decision and seek their own expert advice. This aligns with Connecticut general statutes, particularly those related to disclosure requirements and the agent's duty of care to avoid misrepresentation or concealment of material facts that could affect the property's value or desirability. An approach that involves downplaying or ignoring potential environmental concerns to expedite the sale is professionally unacceptable. This failure to disclose known or reasonably discoverable material defects, including environmental hazards, violates the agent's ethical obligations and potentially Connecticut's disclosure laws. Such an action could lead to legal liability for the agent and the seller, as well as significant buyer dissatisfaction and potential rescission of the sale. Another unacceptable approach is to advise the seller to avoid any environmental testing, even when red flags are present, under the guise of saving costs. While cost is a factor, deliberately circumventing due diligence processes that are necessary to uncover potential environmental liabilities is a breach of professional responsibility. This can expose both the seller and the agent to significant future legal and financial risks if contamination is discovered after the sale. Finally, an approach that involves the agent personally conducting informal environmental assessments or offering opinions on the severity of potential environmental issues is also professionally unsound. Real estate agents are not qualified environmental professionals. Providing such opinions exceeds the agent's expertise and scope of practice, potentially leading to inaccurate assessments and liability. The agent's role is to facilitate the process and ensure that qualified experts are engaged when necessary. Professionals should adopt a decision-making framework that prioritizes transparency, due diligence, and compliance with all applicable laws and ethical standards. This involves understanding the potential environmental risks associated with a property, advising clients on appropriate steps for investigation and disclosure, and ensuring that all parties have access to accurate information to make informed decisions. When in doubt, consulting with legal counsel or environmental experts is a crucial part of responsible practice. Question 9. Governance review demonstrates that a Connecticut mortgage broker is assisting a client who is seeking to purchase a home with a down payment of 10%. The client is concerned about the additional monthly cost associated with the loan. What is the most appropriate action for the broker to take regarding private mortgage insurance, PMI? Option A. Focus on securing the loan approval and mention PMI only if the client specifically asks about additional costs. Option B. Suggest the client increase their down payment to 20% to avoid PMI, without fully explaining the implications of such a significant financial adjustment. Option C. Fully explain the purpose of PMI, its estimated cost, the conditions under which it can be canceled, and provide documentation outlining the cancellation process according to Connecticut's consumer protection guidelines. Option D. Advise the client that PMI is a standard requirement for all loans with less than a 20% down payment and that it cannot be removed. The correct answer is C. Fully explain the purpose of PMI, its estimated cost, the conditions under which it can be canceled, and provide documentation outlining the cancellation process according to Connecticut's consumer protection guidelines. Explanation. This scenario is professionally challenging because it requires a broker to balance the client's immediate financial concerns with the long-term implications of mortgage insurance, all while adhering to Connecticut's specific regulations regarding mortgage lending and disclosure. The broker must ensure the client understands the nature and cost of private mortgage insurance, PMI, and its eventual cancellation, avoiding any misrepresentation or omission that could lead to financial harm or regulatory noncompliance. The best approach involves proactively educating the client about PMI, including its purpose, cost, and the conditions under which it can be removed. This includes clearly explaining that PMI is typically required for conventional loans with less than a 20% down payment, and that it protects the lender, not the borrower. Furthermore, the broker must provide clear documentation outlining the estimated duration of the PMI payments and the process for requesting its cancellation once the loan-to-value ratio reaches the required threshold, as mandated by Connecticut's consumer protection laws related to mortgage origination and disclosure. This ensures informed consent and compliance with disclosure requirements. An incorrect approach would be to downplay the significance of PMI, focusing solely on securing the loan approval without fully explaining its ongoing cost and the process for its eventual removal. This failure to provide comprehensive information violates ethical obligations and potentially Connecticut's disclosure requirements, as it can lead the borrower to underestimate their total housing expenses. Another incorrect approach is to imply that PMI is a mandatory, permanent feature of the loan, without explaining the borrower's right to request its cancellation under specific conditions. This misrepresentation can cause undue financial burden on the borrower and is contrary to the intent of federal regulations like the Homeowners Protection Act, which Connecticut law generally aligns with regarding PMI cancellation. Finally, an incorrect approach would be to avoid discussing PMI altogether, assuming the client will understand or that it is a standard part of the loan. This omission is a significant failure in fiduciary duty and disclosure, leaving the client uninformed about a substantial cost associated with their mortgage and potentially violating Connecticut's requirements for clear and accurate communication in mortgage transactions. Professionals should employ a decision-making framework that prioritizes transparency and client education. This involves anticipating client questions, proactively providing all relevant information, and ensuring that the client fully comprehends the terms and costs of their mortgage, including any associated insurance policies. This proactive and thorough approach not only ensures regulatory compliance, but also builds trust and fosters responsible homeownership. Question 10. Process analysis reveals that a Connecticut resident with a gross monthly income of $7,500 and total monthly debt obligations, excluding potential mortgage payment of $2,500, is interested in purchasing a home. They are exploring FHA-insured loans. Given that the median home price in their Connecticut county is $450,000, and the FHA allows a maximum total debt-to-income ratio of 43%, what is the approximate maximum FHA loan amount they could potentially qualify for, assuming standard FHA underwriting and no other limiting factors? Option A, $400,000. Option B, $300,000. Option C, $450,000. Option D, $350,000. Correct answer is B, $300,000. Explanation: scenario analysis. This scenario presents a common challenge for Connecticut real estate licensees when advising clients on financing options. The complexity arises from understanding the specific eligibility requirements and financial calculations associated with government-backed loans, particularly when a client's financial situation might push the boundaries of standard underwriting. A licensee must not only grasp the general principles of FHA, VA, and USDA loans, but also be able to apply them accurately to a client's specific circumstances, ensuring they provide compliant and beneficial advice. Misinterpreting loan limits, down payment requirements, or the impact of certain debts can lead to significant financial repercussions for the borrower and potential liability for the licensee. Correct approach analysis. The best professional practice involves accurately calculating the maximum loan amount a client can afford based on the specific guidelines of the FHA loan program, considering the Connecticut median home price and the borrower's debt-to-income ratio. This approach directly addresses the core of the client's inquiry by providing a concrete, FHA-compliant borrowing capacity. The FHA loan program, regulated by the U.S. Department of Housing and Urban Development (HUD), has specific loan limits that vary by county and are generally set at 115% of the median home price in a given area, or a national floor/ceiling, whichever is higher. For Connecticut, these limits are crucial. The calculation must also incorporate the borrower's gross monthly income and their total monthly debt obligations to determine the maximum allowable debt-to-income (DTI) ratio, which for FHA loans is typically 43% for the total DTI. By performing this precise calculation, the licensee adheres to regulatory requirements and provides the client with actionable, accurate information. Incorrect approach is analysis, providing a loan amount based solely on a general understanding of FHA loan limits without considering the specific Connecticut median home price, and the borrower's DTI ratio is a failure to apply the program's specific underwriting criteria. This could result in an inflated or underestimated loan amount, misleading the client and potentially leading them to pursue a loan they cannot qualify for or miss out on a larger loan they could have obtained. Suggesting a loan amount based on VA loan eligibility without confirming the client's veteran status and understanding the VA's unique entitlement and guarantee structure is a significant regulatory failure. VA loans have no set loan limits for borrowers with full entitlement, but the lender's maximum loan amount is still influenced by the borrower's income and creditworthiness. Presenting this as an FHA option is a misrepresentation of the loan product and its requirements. Recommending a loan amount based on USDA loan eligibility without verifying the property's location within an eligible rural or suburban area, and the borrower's income being at or below the moderate income limits for the region, is a violation of USDA program rules. USDA loans are geographically restricted and income sensitive, and advising on them without these checks is non-compliant. Professional reasoning. Professionals should approach such inquiries by first identifying the specific loan program the client is interested in or most likely to qualify for. Then, they must consult the most current official guidelines for that program, including any state-specific adjustments or limitations, like median home prices for FHA. A thorough debt-to-income ratio calculation, using the borrower's verified income and all listed monthly debts, is paramount. If the client is exploring multiple options, each program's unique requirements, e.g., veteran status for VA, property location for USDA, must be individually assessed. The goal is to provide accurate, compliant, and client-beneficial information that empowers informed decision-making. Question 11. The audit findings indicate a need to review the practices of real estate brokers in Connecticut when assisting clients with financing options, specifically concerning hard money loans and seller financing. A broker is working with a client who needs to close on a property quickly and has limited traditional financing options. The broker has identified a potential hard money lender and a seller willing to offer seller financing. Which of the following represents the most prudent and compliant course of action for the Connecticut licensed broker? Option A. Advise the client on the tax implications of seller financing and the best way to structure the loan to minimize their tax liability without consulting a tax professional. Option B. Present only the hard money loan option to the client, as it is typically faster than seller financing, and avoid discussing seller financing to prevent potential complications. Option C. Proceed with the hard money loan immediately to meet the client's urgent closing timeline, assuming the lender is reputable based on their website. Option D. Thoroughly vet the hard money lender's licensing and reputation in Connecticut, and ensure all seller financing terms are clearly documented in a legally sound agreement that complies with Connecticut disclosure requirements. Correct answer is D. Thoroughly vet the hard money lender's licensing and reputation in Connecticut, and ensure all seller financing terms are clearly documented in a legally sound agreement that complies with Connecticut disclosure requirements. Explanation. This scenario is professionally challenging because it requires a broker to balance the client's immediate need for financing with the long-term implications and regulatory compliance. The broker must ensure that the proposed financing options are not only feasible, but also align with Connecticut's real estate and lending regulations, protecting both the client and themselves from potential legal and ethical pitfalls. Careful judgment is required to differentiate between legitimate financing tools and those that could be misconstrued or used improperly. The best approach involves thoroughly vetting the hard money lender's licensing and reputation, and ensuring the seller financing terms are clearly documented and compliant with Connecticut law, including disclosure requirements. This proactive due diligence protects the client from predatory lending practices and ensures the transaction adheres to all legal statutes. It demonstrates a commitment to ethical conduct and regulatory adherence, which are paramount for licensed real estate professionals in Connecticut. An approach that solely focuses on the speed of closing, without verifying the hard money lender's credentials or the clarity of seller financing terms, is professionally unacceptable. This oversight could lead to the client entering into an agreement with an unlicensed or unscrupulous lender, or agreeing to unfavorable terms in a poorly documented seller financing deal, potentially violating Connecticut's consumer protection laws and lending regulations. Another unacceptable approach is to present only hard money loan options without exploring seller financing, or vice versa, without a clear rationale based on the client's specific financial situation and risk tolerance. This can be seen as steering the client towards a particular product without a comprehensive evaluation of all viable and suitable options, potentially breaching the broker's fiduciary duty. Finally, an approach that involves advising the client on the legal intricacies of loan documents without being a licensed attorney in Connecticut constitutes the unauthorized practice of law. While a broker can explain the general implications of terms, providing legal advice is beyond their scope and is a serious ethical and legal violation. Professionals should employ a decision-making framework that prioritizes client education, comprehensive due diligence on all financing sources, clear and transparent communication, and strict adherence to all applicable Connecticut real estate and lending laws. This includes understanding the nuances of both hard money and seller financing, their respective risks and benefits, and ensuring all documentation is legally sound and fully disclosed to the client. Question 12. Governance review demonstrates that a real estate licensee in Connecticut is preparing to advise a client on the sale of a commercial property. To ensure compliance with Connecticut's real estate laws and ethical standards, what fundamental understanding of real estate is most critical for the licensee to possess and apply in this situation? Option A. Real estate is primarily a commodity to be traded for maximum financial gain, with minimal emphasis on legal complexities. Option B. Real estate is defined solely by its current market valuation, irrespective of the underlying legal rights or physical attributes. Option C. Real estate encompasses the physical land and any permanent structures, along with the associated legal rights of ownership, possession, enjoyment, and disposition. Option D. Real estate is exclusively the tangible land and buildings, with no significant consideration given to the rights of ownership. The correct answer is C. Real estate encompasses the physical land and any permanent structures, along with the associated legal rights of ownership, possession, enjoyment, and disposition. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a real estate licensee in Connecticut to understand the fundamental definition and importance of real estate beyond mere physical property. Misinterpreting this definition can lead to misrepresentation, ethical breaches, and potential legal repercussions under Connecticut's real estate laws and regulations. The licensee must grasp that real estate encompasses not just land and buildings, but also the bundle of rights associated with ownership, which is crucial for accurate client advice and transaction execution. Correct approach analysis. The best professional approach involves recognizing that real estate, as defined by Connecticut law and understood in practice, is a comprehensive concept that includes the physical land and any permanent structures, as well as the associated legal rights of ownership, possession, enjoyment, and disposition. This understanding is vital for properly advising clients on property value, marketability, and the implications of various transaction structures. It aligns with the Connecticut Real Estate Commission's mandate to ensure licensees act with competence and integrity, providing accurate information to the public. Incorrect approaches analysis. One incorrect approach is to view real estate solely as the physical land and buildings, ignoring the associated legal rights. This narrow perspective fails to acknowledge the full scope of what is being bought, sold, or leased, potentially leading to incomplete or misleading advice to clients regarding their ownership interests and the limitations or benefits thereof. This is a failure to meet the standard of competence expected of a licensed professional in Connecticut. Another incorrect approach is to consider real estate as simply a commodity to be traded for profit, without regard for the legal and ethical obligations owed to clients and the public. This transactional mindset overlooks the fiduciary duties and the importance of transparency and fair dealing mandated by Connecticut's real estate licensing laws and ethical codes. It prioritizes personal gain over client welfare and regulatory compliance. A further incorrect approach is to define real estate only in terms of its market value at a given moment, neglecting the underlying legal framework that defines ownership and transferability. While market value is a critical component of a real estate transaction, it is derived from and influenced by the legal definition and rights associated with the property. Focusing solely on market value without understanding the legal underpinnings is an incomplete and potentially deceptive practice. Professional reasoning. Professionals in Connecticut should adopt a decision-making framework that begins with a thorough understanding of the legal and regulatory definitions of key terms like real estate. This foundational knowledge then informs all client interactions, advice, and transaction management. When faced with situations requiring interpretation or application of these definitions, licensees should consult relevant Connecticut statutes, regulations, and professional standards, and if necessary, seek guidance from their broker or legal counsel to ensure compliance and uphold ethical obligations. Question 13. Governance review demonstrates that a mortgage loan originator in Connecticut is assisting a prospective borrower who has a stable employment history, but a variable income stream that, on initial review, appears insufficient to meet standard debt-to-income ratios for conventional loans. What is the most appropriate course of action for the originator to ensure regulatory compliance and ethical practice? Option A. Submit the application to numerous lenders simultaneously without a clear strategy, hoping for an approval, and without fully documenting the variable income. Option B. Conduct a comprehensive review of all disclosed income documentation, explore alternative loan programs that accommodate variable income, and advise the borrower on strategies for documenting their income effectively within regulatory guidelines. Option C. Immediately reject the application without further investigation, assuming the borrower cannot qualify based on the initial income assessment. Option D. Advise the borrower to inflate their stated income on the application to meet the lender's debt-to-income ratio requirements. The correct answer is B. Conduct a comprehensive review of all disclosed income documentation, explore alternative loan programs that accommodate variable income, and advise the borrower on strategies for documenting their income effectively within regulatory guidelines. Explanation. Scenario analysis. This scenario presents a common challenge in the mortgage application process, where a borrower's financial situation may not immediately align with standard lending criteria. The challenge lies in balancing the need to assist the borrower in achieving homeownership with the strict regulatory requirements governing mortgage lending in Connecticut. A broker must exercise careful judgment to ensure compliance, while exploring all legitimate avenues for the applicant. Correct approach analysis. The best professional practice involves thoroughly reviewing the borrower's complete financial profile, including all disclosed income sources, assets, and liabilities, and then identifying potential lending programs or strategies that might accommodate the applicant's specific circumstances within Connecticut's regulatory framework. This approach prioritizes a comprehensive understanding of the borrower's situation and a diligent search for compliant solutions, such as exploring different loan products or documenting non-traditional income streams that meet lender and regulatory standards. This aligns with the Connecticut Department of Banking's emphasis on responsible lending and accurate representation of a borrower's ability to repay. Incorrect approach is analysis. One incorrect approach is to immediately dismiss the application based on a superficial review of the stated income, without exploring all disclosed financial information or potential alternative lending programs. This fails to meet the professional obligation to diligently assist the applicant and may violate fair lending principles by prematurely excluding a borrower without a full assessment. Another incorrect approach is to suggest the borrower misrepresent their income or employment status to qualify for a loan. This is a direct violation of federal and state lending laws, including those enforced by the Connecticut Department of Banking, and constitutes fraudulent activity, carrying severe legal and ethical consequences. A third incorrect approach is to submit the application to multiple lenders without the borrower's explicit consent or a clear strategy, hoping one will approve it. This can lead to unnecessary credit inquiries, potentially harming the borrower's credit score, and demonstrates a lack of organized and ethical loan origination practices. Professional reasoning. Professionals should adopt a systematic approach. First, Conduct a complete and accurate assessment of the borrower's financial situation as disclosed. Second, research and identify all available loan products and programs that the borrower might qualify for, considering their specific circumstances and Connecticut's lending regulations. Third, communicate transparently with the borrower about their options, the requirements for each, and any potential challenges. Finally, always adhere strictly to all applicable federal and state laws and ethical guidelines, ensuring no misrepresentation or fraudulent activity occurs. Question 14. Stakeholder feedback indicates that clients are increasingly interested in diversifying their real estate investments beyond direct property ownership. A Connecticut real estate broker is discussing investment strategies with a client who has expressed interest in real estate investment trusts. Rate. Which of the following represents the most appropriate and compliant course of action for the broker? Option A. Inform the client that rate are outside the scope of real estate brokerage and offer no further information or guidance on the topic. Option B. Explain what rate are in general terms, discuss their common structures and how they relate to real estate, and then advise the client to consult with a licensed securities professional or financial advisor for specific investment recommendations. Option C. Recommend a specific publicly traded rate that has shown strong historical performance and dividend yields, while including a disclaimer that this is not investment advice. Option D. Provide a detailed analysis of several different rates, including their financial statements and market trends, to help the client make an informed decision. The correct answer is B. Explain what rate are in general terms, discuss their common structures and how they relate to real estate, and then advise the client to consult with a licensed securities professional or financial advisor for specific investment recommendations. Explanation. This scenario is professionally challenging because it requires a real estate licensee in Connecticut to balance the fiduciary duty owed to a client with the complexities of recommending investment vehicles like real estate investment trusts. Rate. A licensee must ensure they are operating within the scope of their license and providing advice that is suitable and compliant with Connecticut real estate and securities regulations. The primary challenge lies in distinguishing between providing general information about investment types and offering specific investment advice, which may require additional licensing or fall outside the purview of a real estate license. The best approach involves understanding the limitations of a Connecticut real estate license and the nature of rate as securities. A licensee's primary responsibility is to facilitate real estate transactions. While they can provide general information about different ways real estate can be invested in, including rate, they must avoid offering specific recommendations or advice on whether to buy, sell, or hold a particular rate. This approach aligns with Connecticut general statutes and the regulations governing real estate brokers and salespersons, which do not typically authorize them to provide investment advice on securities. The ethical obligation is to act in the client's best interest by guiding them to appropriate professionals for investment advice, such as a licensed securities broker or financial advisor. Recommending a specific rate without proper licensing is a significant regulatory and ethical failure. This constitutes practicing as an unregistered securities broker or investment advisor, violating Connecticut securities laws and potentially federal securities laws. It also breaches the fiduciary duty by exposing the client to unsuitable investment advice and the licensee to potential legal and disciplinary action. Providing a detailed analysis of a rate's historical performance and dividend yields, even with a disclaimer, can still be interpreted as providing investment advice. While factual, the context of a client seeking investment guidance from their real estate agent can lead them to rely on this information as a recommendation, blurring the lines of permissible activity. This can create liability for the licensee if the investment performs poorly. Suggesting that the client research rate independently without offering any information or context about them is unhelpful and fails to meet the client's implicit need for guidance. While it avoids offering direct advice, it also neglects the opportunity to inform the client about the existence and general nature of rate as a potential investment avenue, which could be part of a broader discussion about real estate investment strategies. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves clearly defining the scope of their license and expertise. When a client's needs extend beyond the licensee's authorized services, the professional ethical response is to refer the client to qualified professionals in those other fields. This ensures the client receives appropriate advice and protects the licensee from engaging in unauthorized practice. Question 15. The monitoring system demonstrates that a Connecticut real estate licensee, acting as a seller's agent, has received an offer on a listed property. The offer is below the asking price, but the licensee has learned from the buyer's agent, who is not affiliated with the licensee's brokerage, that the buyer is willing to pay significantly more than their offered price. The buyer's agent has indicated that if the licensee's brokerage were to represent the buyer as well, the buyer would likely submit a higher offer. What is the most appropriate and legally compliant course of action for the Connecticut licensee? Option A. Proceed as the seller's agent, encouraging the seller to counter the offer at the buyer's maximum price without disclosing the buyer's willingness to pay more to the seller, and without informing the buyer of the licensee's exclusive representation of the seller. Option B. Advise the seller to accept the current offer, as it is the only offer on the table, and avoid mentioning the buyer's potential to pay more to the seller or the buyer's willingness to consider dual agency. Option C. Immediately disclose the buyer's willingness to pay more to the seller, and inform the buyer's agent that the licensee's brokerage must now disclose this potential dual agency situation to both parties and obtain their informed written consent before proceeding with any further negotiations or representation. Option D. Suggest to the buyer's agent that the buyer should find another agent to represent them in this transaction to avoid any appearance of impropriety, without fully explaining the implications of the current agency relationship. Correct answer is C. Immediately disclose the buyer's willingness to pay more to the seller and inform the buyer's agent that the licensee's brokerage must now disclose this potential dual agency situation to both parties and obtain their informed written consent before proceeding with any further negotiations or representation. Explanation. This scenario presents a professional challenge because it pits a real estate licensee's fiduciary duty to their client against the potential for a higher commission, creating a conflict of interest that must be navigated with strict adherence to Connecticut's agency disclosure and representation laws. The licensee must prioritize their client's best interests and maintain transparency, even when faced with a financially advantageous but ethically compromised situation. The best professional approach involves immediately disclosing the potential dual agency situation to both the seller and the prospective buyer, in writing, as required by Connecticut general statutes. This disclosure must clearly explain the implications of dual agency, including the limitations on the licensee's ability to advocate exclusively for either party. Obtaining informed written consent from both parties before proceeding with any representation under a dual agency framework is paramount. This approach upholds the licensee's duty of loyalty and full disclosure to both parties, ensuring compliance with Connecticut's stringent real estate agency laws and ethical standards, thereby protecting both the client and the licensee from potential legal and professional repercussions. An approach that involves prioritizing the higher commission by subtly steering the buyer towards the seller's property without full disclosure of the dual agency relationship is ethically unacceptable and a violation of Connecticut's real estate licensing laws. This action breaches the duty of loyalty owed to the seller and misrepresents the licensee's role to the buyer, potentially leading to claims of misrepresentation and breach of fiduciary duty. Another unacceptable approach would be to proceed as the seller's agent, advising the seller to accept the buyer's offer without disclosing the buyer's willingness to pay more, or without informing the buyer that the licensee is exclusively representing the seller. This failure to disclose material information and the potential conflict of interest violates the duty of full disclosure and loyalty to the seller, and potentially misleads the buyer. Finally, attempting to avoid the dual agency situation by suggesting the buyer seek independent representation without fully explaining the implications of the current situation and the licensee's obligations would also be professionally unsound. While encouraging independent counsel is sometimes appropriate, in this context, it fails to address the immediate disclosure requirements and the licensee's existing obligations to the seller. Professionals should employ a decision-making framework that begins with identifying potential conflicts of interest. This is followed by a thorough review of relevant state statutes and regulations, in this case, Connecticut's agency laws. The next step is to communicate transparently and promptly with all parties involved, seeking informed consent for any proposed agency arrangement. Prioritizing ethical conduct and client welfare over personal financial gain is the cornerstone of responsible real estate practice. Question 16. Benchmark analysis indicates that a seller in Connecticut is highly motivated to sell their property within a specific time frame and has engaged a real estate broker to manage the sale. The seller wants to ensure the broker is compensated for their marketing efforts, but is also concerned about potentially paying a commission if they happen to find a buyer through their own personal network, without the broker's direct involvement. Considering these seller objectives and the regulatory landscape in Connecticut, which type of listing agreement would best serve the interests of both the seller and the broker? Option A. A net listing agreement, where the broker earns any amount over a predetermined net price set by the seller. Option B. An open listing agreement, where any broker who brings a buyer earns the commission, and the seller can also sell the property themselves without owing a commission. Option C. An exclusive right to sell listing agreement, which guarantees the broker a commission if the property sells during the listing period, regardless of who finds the buyer. Option D. An exclusive agency listing agreement, where the broker earns a commission unless the seller finds the buyer themselves. The correct answer is C. An exclusive right to sell listing agreement, which guarantees the broker a commission if the property sells during the listing period, regardless of who finds the buyer. Explanation. Scenario analysis. This scenario presents a professional challenge because a real estate broker must balance the fiduciary duty owed to their client with the practical realities of marketing a property effectively. Misunderstanding or misapplying different listing agreement types can lead to legal disputes, financial losses for the seller, and damage to the broker's reputation and license. Careful judgment is required to select the agreement that best aligns with the seller's goals and the broker's ability to earn a commission. Correct approach analysis. The best professional practice involves recommending an exclusive right to sell listing agreement when the seller is committed to selling and wants to ensure the broker is compensated for their marketing efforts, regardless of who procures the buyer. This agreement provides the strongest incentive for the broker to invest time and resources into marketing the property, as they are guaranteed a commission if the property sells during the listing period. This aligns with Connecticut's regulations, requiring clear and unambiguous listing agreements that define the terms of the broker's employment and commission entitlement, protecting both parties by establishing clear expectations. Incorrect approaches analysis. Recommending an exclusive agency listing agreement, while legally permissible, is less ideal if the seller is highly motivated and the broker is confident in their marketing strategy. This agreement leaves open the possibility that the seller could procure a buyer independently and avoid paying a commission, potentially undermining the broker's efforts and financial return. This could be seen as a failure to fully advocate for the broker's earned compensation. Suggesting an open listing agreement is generally the least advisable approach for a motivated seller and a professional broker. This type of agreement offers the weakest incentive for the broker, as any broker who brings a buyer can earn the commission, and the seller could also sell the property themselves without owing a commission to anyone. This approach fails to provide adequate protection for the broker's investment of time and resources, and could lead to disputes over commission entitlement, potentially violating the broker's duty to secure a clear and enforceable agreement. Professional reasoning. Professionals should always begin by thoroughly understanding the seller's motivation, timeline, and risk tolerance. They should then explain the implications of each listing agreement type, focusing on how each impacts commission certainty and the broker's incentive to market. The recommendation should prioritize the agreement that best serves the seller's primary goal of selling the property, while ensuring the broker's compensation is clearly defined and protected, in accordance with Connecticut real estate licensing laws. Question 17. Market research demonstrates that a property listed for sale in Greenwich, Connecticut, is subject to a utility easement that crosses a portion of the backyard. The seller states the easement has been there for years and has never caused any issues. As the listing agent, what is the most professional and legally compliant approach to handling this easement? Option A. Rely on the seller's verbal assurance that the easement has never caused issues and proceed with the sale without further investigation or disclosure beyond a general mention of potential easements. Option B. Clearly disclose the existence and location of the utility easement on all listing materials, and in the purchase agreement, advising the seller to obtain a survey or legal opinion if the easement's impact is unclear or contested, and ensuring potential buyers understand its implications. Option C. Downplay the significance of the easement in marketing materials and discussions with potential buyers, focusing only on the property's positive attributes. Option D. Advise the seller to remove or relocate the easement before listing the property, assuming this is a significant impediment to sale. The correct answer is B. Clearly disclose the existence and location of the utility easement on all listing materials and in the purchase agreement, advising the seller to obtain a survey or legal opinion if the easement's impact is unclear or contested, and ensuring potential buyers understand its implications. Explanation. This scenario presents a professional challenge because a real estate licensee must navigate the complexities of property rights and ownership while ensuring full disclosure and avoiding misrepresentation, which are core tenets of Connecticut real estate law and ethical practice. The licensee's duty is to represent the client's interests accurately and to inform potential buyers of all material facts affecting the property's value and usability. Misunderstanding or misrepresenting the nature of a property right, such as an easement, can lead to significant legal disputes and financial repercussions for all parties involved. The best approach involves a thorough understanding of the property's legal description and any encumbrances, such as easements, that are recorded in public records. This includes proactively identifying the existence and scope of any easements and clearly communicating this information to the seller and potential buyers. The licensee should then advise the seller to obtain a clear legal opinion or survey if the easement's impact is ambiguous or contested, and ensure that all disclosures accurately reflect the easement's nature and potential impact on the property's use and value. This aligns with Connecticut general statutes, particularly those concerning disclosure requirements and the fiduciary duties of real estate agents, which mandate honesty, fair dealing, and the disclosure of all material facts. An incorrect approach would be to assume the easement is minor or has no practical impact without verification. Failure to investigate and disclose material facts violates the licensee's duty of care and honesty under Connecticut law. Another incorrect approach is to rely solely on the seller's verbal assurances about the easement without independent verification. While sellers are obligated to disclose known material defects, licensees have their own independent duty to investigate and disclose, and cannot delegate this responsibility to the seller. Finally, attempting to downplay or obscure the existence of the easement to facilitate a sale would constitute misrepresentation, a serious ethical and legal violation in Connecticut. Professionals should employ a decision-making framework that prioritizes due diligence, transparency, and adherence to legal and ethical standards. This involves 1. Identifying all potential issues affecting the property's title and use, including recorded encumbrances. 2. Verifying the nature and impact of these issues through reliable sources, such as title reports and legal counsel. 3. Communicating all findings clearly and accurately to all parties. 4. Advising clients on the implications of these issues and recommending appropriate actions to mitigate risks. Question 18. The control framework reveals that a licensed real estate broker in Connecticut, representing a seller in a residential property transaction, learns that the prospective buyer is the broker's former business partner with whom they have an ongoing financial dispute. What is the most appropriate course of action for the broker to take to uphold their professional obligations? Option A. Discreetly negotiate with the buyer, leveraging the past relationship to expedite the sale, and only inform the seller if the deal is finalized. Option B. Inform the seller that due to a potential conflict of interest, the brokerage firm can no longer represent them and advise them to seek new representation. Option C. Immediately disclose the former business relationship and the ongoing dispute to the seller, explaining the potential implications, and obtain the seller's explicit written consent to continue representing them in this transaction. Option D. Proceed with the transaction, assuming the seller would not be concerned about the broker's past relationship with the buyer, and focus solely on securing the best possible price for the seller. Correct answer is C. Immediately disclose the former business relationship and the ongoing dispute to the seller, explaining the potential implications, and obtain the seller's explicit written consent to continue representing them in this transaction. Explanation. The control framework reveals a common challenge in real estate brokerage: navigating potential conflicts of interest when a broker's personal interests might influence their professional advice to a client. In Connecticut, the Real Estate License Law and the Code of Ethics for Real Estate Professionals are designed to ensure that client interests are paramount. This scenario requires a broker to prioritize their fiduciary duties over personal gain or convenience. The correct approach involves full disclosure and obtaining informed consent from the client before proceeding with any action that could be perceived as a conflict. This aligns with Connecticut General Statute Section 20-324 A et sec, which mandates honesty, integrity, and the avoidance of misrepresentation or concealment. Ethically, a broker has a fiduciary duty to their client, which includes loyalty, full disclosure, and acting in the client's best interest. By proactively informing the seller about the potential buyer's relationship and seeking their explicit permission, the broker upholds these duties. This transparency allows the seller to make an informed decision about whether they are comfortable proceeding with the transaction under these circumstances. An incorrect approach would be to proceed without informing the seller of the buyer's relationship. This violates the duty of full disclosure and could be construed as a misrepresentation or concealment of material facts, which is a direct violation of Connecticut's real estate license law. It also breaches the ethical obligation of loyalty and acting in the client's best interest, as the broker's personal connection to the buyer might subtly influence their advice or negotiation strategy, potentially to the detriment of the seller. Another incorrect approach would be to assume the seller would not mind or to downplay the significance of the relationship. This demonstrates a lack of understanding of fiduciary responsibilities and the importance of client autonomy. The broker is not empowered to make such assumptions. The decision rests solely with the client after full disclosure. This approach also fails to adhere to the principle of informed consent, a cornerstone of ethical real estate practice. Finally, an incorrect approach would be to withdraw from representing the seller without any explanation. While withdrawing from a representation is sometimes necessary, doing so without clear communication about the conflict and the reasons for withdrawal can leave the client in a vulnerable position and may still be seen as a failure to properly manage a potential conflict of interest. Professional decision-making in such situations requires a commitment to transparency, adherence to legal and ethical standards, and a clear understanding of fiduciary duties. When a potential conflict arises, the broker must first identify it, then assess its materiality, and finally, implement a strategy that prioritizes client protection and informed consent, always erring on the side of full disclosure. Question 19. The risk matrix shows that Mr. Henderson, a Connecticut resident nearing retirement, is seeking to refinance his mortgage. He has expressed significant anxiety about potential increases in his monthly housing expenses impacting his fixed retirement income. Considering his stated concerns and moderate risk tolerance, which of the following mortgage refinancing approaches would best align with his need for predictable financial outcomes in retirement? Option A, an adjustable rate mortgage arm with an initial fixed rate period, followed by periodic adjustments to the interest rate based on market conditions. Option B, a mortgage product with the lowest initial advertised interest rate, regardless of its long-term payment structure or potential for future increases. Option C, a fixed-rate mortgage where the interest rate and principal and interest payment remain constant for the entire loan term. Option D, an interest-only mortgage that allows Mr. Henderson to pay only the interest for a specified period before principal repayment begins. The correct answer is C, a fixed-rate mortgage where the interest rate and principal and interest payment remain constant for the entire loan term. Explanation: the risk matrix shows a client, Mr. Henderson, who is nearing retirement and has expressed concerns about the stability of his income. He has a moderate risk tolerance, but is particularly anxious about potential increases in his mortgage payments impacting his fixed retirement income. He is considering refinancing his current mortgage. This scenario is professionally challenging because it requires balancing the client's stated financial goals and risk tolerance with the inherent characteristics and risks of different mortgage products. A careful judgment is required to recommend a product that aligns with his need for predictable expenses during retirement. The best approach involves thoroughly assessing Mr. Henderson's specific financial situation, including his projected retirement income, expenses, and his stated anxiety about payment fluctuations. Understanding his desire for payment stability is paramount. Therefore, recommending a fixed-rate mortgage, which offers a predictable interest rate and principal and interest payment for the entire loan term, directly addresses his primary concern about income stability during retirement. This aligns with the ethical obligation to act in the client's best interest and the regulatory requirement in Connecticut to ensure that mortgage recommendations are suitable for the borrower's circumstances. A fixed-rate mortgage provides the certainty Mr. Henderson needs to manage his retirement budget without the risk of payment increases. Recommending an adjustable-rate mortgage ARM without a thorough discussion of its potential payment increases and the client's specific tolerance for such fluctuations would be professionally unacceptable. ARM, by their nature, have interest rates that can change over time, leading to potentially higher monthly payments. This directly contradicts Mr. Henderson's expressed concern about income stability and could lead to a suitability violation under Connecticut's mortgage lending regulations. Suggesting an interest-only mortgage, even with a fixed initial rate, would also be professionally unsound. While the principal payment is deferred, the borrower still faces the risk of payment increases if the interest rate adjusts in an ARM interest-only, or the eventual need to repay the principal, which could be a significant burden on a fixed retirement income. This product does not provide the long-term payment predictability Mr. Henderson requires and could lead to financial distress in retirement, violating the duty of care. Recommending a mortgage product solely based on the lowest initial advertised rate, without considering the client's long-term financial stability and risk tolerance, is a failure to conduct a proper needs assessment. Connecticut regulations emphasize suitability, meaning the recommended product must be appropriate for the borrower's financial situation and objectives. Focusing only on the initial rate ignores the potential long-term implications of different mortgage types, especially for a client nearing retirement. Professionals should employ a client-centric decision-making process. This involves actively listening to the client's concerns, conducting a comprehensive financial assessment, understanding their risk tolerance and long-term goals, and then matching these factors with the features and risks of available mortgage products. The process should prioritize transparency about all potential outcomes and costs associated with each product, ensuring the client can make an informed decision that aligns with their best interests. Question 20. The control framework reveals that a property in Hartford, Connecticut, is scheduled to close on April 15, 2024. The annual property tax bill for this property is $7,300 and taxes are paid in arrears. The seller has owned the property for the entire calendar year prior to the closing year. Assuming the closing occurs on April 15, 2024, and the tax year runs from January 1 to December 31, what is the seller's prorated share of the property taxes due at closing? Option A, $3,650.00. Option B, $3,458.33. Option C, $3,575.00. Option D, $3,700.00. The correct answer is C, $3,575.00. Explanation. The control framework reveals that real estate contracts in Connecticut are governed by specific statutes and common law principles that dictate their enforceability. This scenario presents a challenge because it requires a licensee to accurately calculate prorated expenses based on contract terms and Connecticut real estate law, ensuring fairness to both buyer and seller at closing. Miscalculations can lead to disputes, financial losses, and potential claims of negligence or breach of contract. The best professional approach involves meticulously reviewing the purchase agreement for the agreed-upon prorations and applying the standard Connecticut method for calculating per diem expenses. This method typically involves dividing the annual cost by 365 days, or 366 in a leap year, to determine the daily rate, and then multiplying that by the number of days each party is responsible for the expense. For property taxes, which are often paid in arrears in Connecticut, the seller is responsible for the portion of the tax year up to, but not including, the closing date, and the buyer is responsible from the closing date forward. This aligns with the principle of equitable apportionment of expenses, ensuring neither party is unfairly burdened. An incorrect approach would be to simply divide the annual property tax bill by 12 and prorate based on months, ignoring the specific closing date and the actual number of days in the tax period. This fails to account for the precise timing of the transfer of ownership and can lead to inaccurate prorations, potentially shortchanging one party. Another incorrect approach would be to use a 30-day month convention for prorating. Sometimes used in other financial contexts, real estate prorations in Connecticut are generally based on the actual number of days in the year and the specific period in question, reflecting the precise duration of ownership. Using a standardized 30-day month ignores the actual calendar and can result in significant inaccuracies, especially for closings near the end or beginning of months with varying lengths. Finally, an incorrect approach would be to assume the seller has paid all property taxes for the current year and therefore owes nothing at closing, regardless of the closing date. This overlooks the fact that property taxes are often paid in arrears and that the seller is liable for their portion of the tax year up to the closing date, even if the tax bill has not yet been issued or paid. This demonstrates a fundamental misunderstanding of how property tax obligations are handled in real estate transactions. Professionals should approach such situations by 1. Thoroughly understanding the terms of the purchase agreement regarding prorations. 2. Familiarizing themselves with Connecticut statutory and common law regarding real estate prorations, particularly for property taxes. 3. Performing precise calculations using the actual number of days in the relevant period. 4. Clearly communicating the proration calculations to both buyer and seller, explaining the basis for the amounts. 5. Consulting with the closing attorney or title company if any ambiguity exists.